recovery, there's no reason to think that that in and of itself is a reason for the economy to roll over into recession. Now, when we look at economic contractions, we see a couple of things that are very different. The first thing that we see that is different, all contractions are relatively short compared to expansions. Yes, we did have one expansion that was only 12 months, but outside of that, every other expansion has been longer than even the longest contraction. And of course, this shouldn't be a big surprise, right? The economy mostly grows over time. We have a growing labor force, we have a growing capital stock, we have growing total factor productivity. So we know the economy has to be growing over long periods of time, and it's going to spend more time growing than it does in these business contractions. The second thing to notice is the dispersion between the lengths of the shortest contraction to the longest is actually not very big. Remember, in expansions, the dispersion was from 1 year in 1980 to 10 years in 1991. But here, the dispersion is 6 months to 18 months. Not a whole lot. 18 months, the last recession, one of the reasons we call it the Great Recession, it's been the longest recession of the post-World War II period. And if you look through all of these, including the last recession in the 70s and the early 80s, what do we see? Long recessions. What do we see? Is an average of about 11 or 12 months. So recessions generally don't last very long. That'll be an important point a little bit later when we talk about differences in the way economists think about how or if the government should respond to a recession. Now, we're often interested when a recession or an economic expansion is taking place is, okay, we know what's happening to real GDP, but what's happening to a lot of the other economic variables that we care about? And when we compare those movements, we're talking about something that is referred to as co-movement. How do two variables move together? And there's three ways of classifying those. Direction. Do they move in the same direction, or do they move in opposite directions? Timing. Do they move at the same time, essentially the same time, or does one of the variables move first and the other one second? And finally, how volatile are the series? Is one more volatile or less volatile? When we think about direction, when variables move in the same direction, it is referred to as pro-cyclical. When variables move in opposite directions, it's referred to as counter-cyclical. And of course, there may be some variables that just don't move, or move sometimes pro-cyclical and sometimes counter-cyclical. You can't figure out any sort of relationship. As far as the timing is concerned, we generally talk about this with respect to how GDP is moving. So some variables might move first, other variables might move last. So as an example, building permits is considered to be a leading economic variable. It takes time to build houses, so when a contractor goes to get a permit, it's basically his belief or her belief that the economy will still be just fine 6, 9, 12 months down the road once the house is completed so they can sell it. So building permits generally move before, or changes in building permits, generally move before changes in GDP. We'll see that a lot of variables move at exactly the same time. And there are a few variables that move after the fact. We'll look at one of those a little bit later. And then, of course, volatility can be higher, lower, or broadly the same. So let's actually look at a bunch of variables and see what we can see. Now remember that our national income identity said that economic output is equal to consumption plus investment plus government purchases plus net exports. So those components might be interesting to look at in and of themselves. So just to give you an idea, this is GDP and how it's changed over the course of a year. I also want you to notice that if I draw a vertical line at about 1985, that the volatility pre-1985 is greater than the volatility post-1985, suggesting that something happened in there, and that's something that we will have to see if we can't figure out as we move through the course, the remainder of the course. Okay. Now here's real GDP in blue and consumer spending in brown, orange, whatever that color is. A couple of things to notice. They look like they move exactly together. Maybe not exactly, but really, really closely together. So what we can say then is consumer spending is pro-cyclical, it is coincident, and it has about the same volatility as real GDP. In fact, the simple correlation coefficient here is 0.8, suggesting again that these two series are very, very highly related. Now, of course, for the United States, this should not be a big surprise. We've already seen that the consumption share of GDP is up around 70%. So if consumption is doing whatever it's doing, and it's 70% of the total, then pretty much the total is going to have movements that are very, very similar. Now, keep that in mind with this. Again, the blue line is real GDP. The orange line is business or non-residential fixed investment. So this is the capital I in our C plus I plus G plus NX, except this is only part of that I. It's not housing construction, and it's not inventory investment. This is businesses building factories and warehouses and office complexes and hotels and buying machines and desks and computers and transportation equipment and all the other kinds of things that they invest in order to run their businesses. So if we look closely here, a couple of things that we can see. Pro-cyclical. The ups and downs move together. Roughly coincident, meaning they move basically at the same time as one another. But as you can easily see, investment is much more volatile than is overall GDP, which of course suggests that this volatility in investment is one of the factors that drives business fluctuations. I mean, look at these changes. Again, you'll notice the dampening of the volatility. But prior to 1985, you often saw increases of up to 20% and decreases down around 10%. So a lot more up and down. When investment's falling very sharply, it's generally pulling GDP down. When it's booming, it's, of course, pulling GDP up. But remember, business fixed investment is only about 11 or 12% of the economy. So it has a lot to do with the fluctuations in GDP, but not a lot to do with the overall levels of GDP. The simple correlation coefficient, 0.75, almost as high as consumption, but clearly a lot more volatile. Now, this is residential investment. So this is home building. Right? Home building includes single-family houses, apartment complexes, condominium units, additions and repairs, all those kinds of things are involved there. Again, maybe you can see, pro-cyclical. The ups and downs move together. Housing is roughly coincident to slightly leading and much, much more volatile. You want to know why the Great Recession was so bad? Look at what happened to business investment, falling at almost a 20% rate. Look at what happens to housing construction, falling at a 30% rate. Wow. The investment component basically had the rug pulled out from underneath it. It collapsed and pulled a lot of the economy down with it. Also notice the volatility changes in the mid-1980s. Now, this is real exports, is the brown. And again, the blue is real GDP. Exports are really, really volatile. Somewhat pro-cyclical, but I would say weakly so. Somewhat coincident, but again, weakly so. The simple correlation coefficient is only 0.3, which again should make sense if you think about exports. Exports are things that we make, but we sell abroad. So what should really be driving exports is not our domestic real GDP, but rather foreign real GDP. A strong foreign economy means they have more income, which means they can buy more imports, but their imports are our exports. So since the exports are more driven by foreign economic output than domestic economic output, we get a very weak correlation coefficient. We see just the opposite with imports. So this is imports in brown. Again, we see pro-cyclical, roughly coincident, much more volatile. Here the correlation coefficient is about 0.7. So very, very high, which again helps to reinforce what I just said about exports. Our imports depend a lot on how strong our economy is, even though those imported goods are made abroad. Government purchases. So this is the G portion of our national income identity. Kind of all sorts of stuff going on in there. What we would say here is weakly pro-cyclical, weakly coincident, about the same volatility, but the weakly pro-cyclical, the correlation coefficient here is only about 0.1 or 0.15. It's very low. Again, not terribly surprising if you think about what the government does. Right? The government purchases, the largest portion of government purchases actually turns out to be for employees, police officers, firemen, teachers. Right? As we go through a business cycle, that employment doesn't change very dramatically unless the state and local governments are under lots of financial pressure, as was the case during the Great Recession. So most of the things that the government buys, it continues to buy regardless of whether the economy is particularly strong or particularly weak, which of course would break down the correlation or the co-movement with real GDP. And that's exactly what we see. One thing, though, that I do want you to note is one of the bigger gaps between economic output and government purchases has taken place in the last 5 or 6 years. Notice here the economy has been growing 2.5%, but the government sector, government purchases, has actually been shrinking by 1.5%, 2.5%. And that gap between the two, there are other periods where we can find big gaps, but this really sort of stands out. So those are the major components of GDP. Notice that most of them are pro-cyclical and coincident, meaning all sectors of the economy have a tendency to move up and down together, with the investment, both business fixed investment and residential investment, being quite volatile, consumption being about average volatility, and the government having a little bit less volatility. Now let's think about some other variables as well. The unemployment rate. Now one thing to notice about the unemployment rate is that it goes up during recessions. So here's a recession, here's a recession, here's a recession, another recession. Well, we had a lot of recessions. So the first thing we can say about the unemployment rate, it is counter-cyclical. As the economy is moving down during a recession, the unemployment rate is moving up. I just point this out. Also note that the declines in the unemployment rate after the recession are much slower than the increases in the unemployment rate during the recession. So the unemployment rate rises very quickly during recessions, but it comes down somewhat more slowly during the economic expansions. This is a consumer price index. So this is a measure of inflation. So if we look at inflation, one of the things that we would see is that in the latter stages of an economic expansion, the inflation rate is generally on a rising trend. So most of the time, the inflation rate is rising as the economy is expanding. So we would think of this as being pro-cyclical. However, one thing that we note, it's not completely obvious on this diagram, just because it's not refined enough, is that the inflation rate typically peaks after the peak of the business cycle, meaning that inflation is a lagging economic indicator. Again, it doesn't necessarily show up well in this particular diagram, but if we look at monthly data, 3-month moving average data, we would see that typically the peak in inflation is well after the peak of the business cycle, closer to the middle or the end of the recession. So we would say that inflation then is a coincident indicator, but also a lagging indicator. Interest rates. The federal funds rate is the interest rate that the Federal Reserve controls or heavily influences. Again, you will notice in the late stages of an economic cycle, that is an expansion period, the Federal Reserve is typically raising short-term interest rates. So short-term interest rates, we could say, would be coincident. But in this case, we almost always see, not always, but almost always see the peak interest rates before the recession begins. Not always. Here's a case where it didn't peak until later. Here's another one. So the short-term interest rates, then, are a leading economic indicator. Pro-cyclical, but leading. Now, you might be interested to note, inflation was a pro-cyclical variable, and short-term interest rates are a pro-cyclical indicator. We'll come back to that relationship next Thursday when we talk more about how central banks determine their monetary policies. Now, this is a relationship between a long-term Treasury security, 10 years, and a short-term Treasury security, a 3-month Treasury bill. This sometimes referred to as a term spread, right? The spread between interest rates at different maturities, maturity spread as well, and is basically a summary measure of the yield curve. And one thing to notice is typically during an economic expansion, the interest rates are, or the spread is falling right before we get into a recession. So what does that mean? The difference between the two is getting smaller and smaller. Now think about the previous chart, the federal funds rate. This is the interest rate that the Federal Reserve controls. It was generally rising going into a recession. The 3-month Treasury bill will largely reflect what's happening to the Fed funds rate. They move in the same direction very, very closely together. So as we're moving into the latter parts of an economic expansion, the 3-month Treasury bill rate is rising. Now it also turns out the 10-year Treasury note rate is also generally rising, but not nearly as quickly. So short-term rates are coming up faster than long-term rates are moving, so the difference is getting smaller and smaller. Once the recession hits or the Federal Reserve starts to lower interest rates, we see that short-term interest rates now begin to come down much more quickly than long-term rates do. So the spread during the recession now goes back up. So this is one of those features that investors like to look at to determine whether a recession is on the horizon. Notice that every recession has either a very low or negative relationship. That is, that 3-month Treasury yields would be higher than 10-year Treasury yields. Remember earlier we said when we were talking about interest rates, we said most of the time long maturities give you a higher yield than short maturities. You don't get your money back for a long period of time. There's more risk associated with long-term maturities. So on occasion, though, that won't be the case. And there's information in that relationship. So notice here then that this term spread or maturity spread would then be considered countercyclical. Right? It's falling during the late stages of an economic cycle, and then it rises during the recession. So it's a countercyclical variable. Finally, we have something that is known as a credit spread. So in a credit spread, what we're looking at is the difference between a private sector borrowing, think about a company or an individual, and the government. So a so-called risky borrower versus a safe borrower like the government. So this is looking at corporate borrowing rates minus government borrowing rates. And what you can see is during a recession, we see those borrowing rates rise. Sometimes a lot, sometimes not so much. And if you think about it, that's probably the way it should work. During a recession, economic activity is falling. That means incomes are falling, including corporate profits. In fact, corporate profits are much, much more volatile than is economic activity. So corporate profits fall a lot during a recession, meaning the payment ability of the corporation has been reduced. Right? Fewer corporate profits, the less money the company has now to make its interest and debt repayments. So they become somewhat riskier. And as that's the case, we should see this spread widen out. Now, one of the things that you can see is it widened out a lot during the Great Recession, 2008, 2009. In fact, this is partly reflective of what happened, the failure of Lehman Brothers and the disruption of the financial markets that led to this huge spike. So what we see here again is a variable that is a countercyclical variable. Rises during recessions, recovers during economic expansions. We'll be coming back to this credit spread on Tuesday. Now, one of the most interesting things about controversies in macroeconomics is to listen to discussions of different macroeconomists from different schools of thought, and to listen to their discussions without ever talking about, are you talking about the next year, or are you talking about the next 10 years? Are you talking about a solo growth model outcome, or saving and investment outcome, or are you talking about something that might happen in the next year or 2 or 3? And those time horizons can actually be quite important. So we need to think a little bit about what we mean by the long run and what we mean by the short run. As I mentioned, the models that we've already covered are really thought primarily as long-run models. Now remember, in our production function, when we talked about long-run models, we were basically talking about the labor market being in equilibrium. In the solo growth model, when we talk about the long-run equilibrium, we're talking about the steady state. So in general, when economists use the word in the long run, they're talking about any class of models that we can assume that all markets are in equilibrium. This means the markets for goods and services, but it also means the market for factors of production, like labor, like capital. Right? So on average, we could think over a 10-year period, on average, the real wages that we're seeing probably reflect something close to market equilibrium, so that the quantity supplied and quantity demanded would be equated. So that's what economists typically mean by the long run. So we do not mean, oh, that's exactly 7.5 years or longer. The long run means whatever time period it takes for markets to be treated as if they're on average, they are in equilibrium. So when that happens, when markets are in equilibrium, the price has adjusted to equate quantity supplied with quantity demanded. So that adjustment in prices means that prices can be treated as being flexible.